Let's talk to Marc Ostwald. He's a strategist at ADMISI. Good morning to you, young Mark.
Good morning.
Right, you sent 5 thought-provoking charts. Without further ado, I suggest you go on your soapbox and conduct the interview.
Okay. Well, obviously, the big overnight news was another one of those great instances from our friend Mr. Carney, the Bank of England governor, donning his familiar coat of the unreliable boyfriend. And having, for months actually, the Bank of England, both him and his colleagues on the MPC, have been steering us very much in a direction of a May rate hike. And pretty much along the way, been pointing out that a lot of the data are probably not that material. So we've got a great point lesson here in, yes, economic data do matter. They do frame monetary policy frameworks, but at the end of the day, financial markets will take whatever the bank, whatever a central bank says as read.
Yep.
Therefore, we go through a bunch of weak data this week. We don't shift rate probabilities because the Bank of England's been telling us, look, expect a May rate hike. And by the way, that weak data that we've got, mostly weather related, we're not happy that inflation's coming down fast enough. All of a sudden, well, there's a lot of uncertainty about Brexit. Wages really aren't going up too fast enough. Productivity is disappointing. We're going to have another debate, and everything really now hangs on how the Brexit negotiations go. The point here is actually one about how you conduct policy. So it is that old Bananarama and Fun Boy 3 song, it ain't what you do, it's the way that you do it. And we had a great point lesson by his successor at the Bank of Canada in the middle of the week. They've basically been now for more than a year saying, look, yeah, we're very data dependent. We ain't providing you with any guidance. So don't take what we say about anything as being hypersensitive. Mr. Carney, on the other hand, steers us in one direction and then turns and says it's course north-northwest, and suddenly it's no, actually it's south-southeast. Be that as it may, there's plenty of other things going on in the world outside of out of the UK. If we move on to the next chart. Notable also overnight, bond fund flows. I think this is, junk bond flows. I think this is important from the aspect that we've been fretting for a number of weeks that markets a little bit in risk-off mode. Well, the evidence from that is not particularly strong. Yes, to start the year, we did see some widening, as one can see from that chart. That's a spread of junk bonds versus US Treasuries. But of late, we've seen a massive charge for junk bonds. We saw last week a $3 billion inflow into junk bonds, which is the biggest one since 2016. So doesn't seem to be much evidence there of risk off. I would say rather there's a big charge or a big reach for yield. Let's move that on, because obviously people's sense of risk on, risk off is primarily about what goes on with the equity markets. And that's interesting because what you have as a contrast here between what junk bond spreads have been doing and what the junk bond ETF's been doing. And in that sense, the S&P 500, this is the S&P 500 index, which is the yellow one, and the junk bond ETF price, which is the white one, have been basically mirroring each other. In fact, they've been mirroring each other very, very closely. It's debatable which one's leading which, probably the junk bond ETF leading the S&P 500. But it's interesting how there is a very disparate picture there between what's going on in actual spread terms, which is actually what's most material to people who are actually investing. It's the premium of what you're getting. Why are you reaching for yield? Because the premium's attractive. But the ETF's actually not doing quite so well. So interesting from that aspect. Now let's move on elsewhere. Big week this week in commodities.
Yep.
A lot of it driven by oil prices. The CRB Commodity Price Index has finally broken through that high that we made in early January. And we seem to be headed mercilessly higher. Obviously primarily led by oil prices, but also there's a big contribution here from some of the industrial metals, both aluminium due to the Russia sanctions, and nickel, again due to the Russia sanctions, up roughly about another 10% this week. I think the more important point here is it probably helps us to understand why we suddenly saw that sudden turnaround in the yield curve flattening yesterday because everyone suddenly realized we've been quite sanguine about the inflation outlook. We had a bit of an inflation's picking up at the beginning of the year, and then we decided actually it's not going to pick up that much, and particularly when we start looking at the Eurozone inflation data thinking, well, that's still a long way, the Bank of Japan's still a long way, even the US inflation numbers are hardly scary, so why should we have that factored in as a big premium? Suddenly you get this big move in commodity prices, which always provide a fairly long lead-in into inflation trends going forward, and we have to think about where we go from here. Now, final point for the week relates to the bête noire of the currency markets of the moment. We've mentioned in terms of commodity prices, and these two economies have very differing sensitivities. So the white line on this is the Russian ruble against the US dollar.
Yep.
The yellow line is the Turkish lira against the dollar. Now, the Russian ruble generally is a beneficiary of higher commodity prices, but at the moment we're concerned that they may actually be shut out due to the sanctions, particularly on the metals side. But as we've had conflicting signals from the US, I must say, the White House and the UN ambassador, the US UN ambassador seem to be sending different messages. But we have recovered somewhat in the ruble. I think primarily it is a fundamental sort of understanding. Russian debt to GDP is just 12%. So yes, they may be somewhat excluded from the global financial system at the moment, but they are actually fairly well protected. They've got alternative sources of finance from China. Now, let's contrast that with the Turkish lira. We've had two different pieces of news this week. The first one relates to the election in June, which is what caused the lira to recover, having been basically the whipping boy of foreign exchange markets. Which seems to me rather preposterous. I can't really see how anyone thinks that anyone other than Erdogan, who was, is going to win it, and he was the reason why we've been selling off the Turkish lira. There is another side to it also, that we seem to have had a very subtle and confusing shift from what we're going to have in terms of policy from the Turkish Central Bank. They've not been able to raise rates properly, i.e. proper official rates, because the government says, no, you're damaging the economy. This week, but they actually have been, because they've been targeting a completely different unofficial rate, the overnight rate.
Right.
This week, we seem to have shifted things. So we've gone from a policy of we want to raise rates, and we're not, but actually we are, to this week where, we're not going to raise rates, but actually we are. So very confusing. I think the big vulnerability there is if you actually have a look at the profile of Turkish debt, above all government debt, rather less so than corporate debt, because corporate debt's quite low in Turkey relative to GDP, it starts to look a lot like the profile that we saw in Asia pre the Asian financial crisis in 97, 98.
On that note, young Mark, brilliant soapbox stuff. Lovely to see you. Thank you very much.